So how will the Ukraine and Russia war affect your home loan interest rate? And should you choose fixed or floating in today's market? Hi, my name is Kenneth from Keyquest Mortgage. Today we'll be talking about the situation we are having now for the Ukraine as well as Russia war, how this will actually affect Singapore and how it will actually potentially affect your mortgage loan interest rate. So let's dive in deep on this topic today. So number one fact we know is that Russia is one of the biggest exporter in terms of oil and gas as well as grain. And with this war going on and sanctions placed on them, we foresee that will be a spike in terms of oil and gas as well as their export of commodity products. With all this happening in place, what will happen in the US market is that inflation might be accelerated because of the cost of oil and gas has been increased, as well as the commodity product like grain, it will be the price will actually be going up. That will actually cause the inflation to rise even more. And US currently inflation rate is actually at an all-time high. And because of the all-time high, in order to curb the inflation, they need to increase their interest rate to reduce their inflation. Because if their inflation get too big, then we will see a big problem in US dollars currency. How does the US interest rate has an indirect impact in Singapore? Let's take for reference in 2008, we all know that there was a financial crisis. Lehman Brothers actually go bust, and during then 2008 to 2013, we actually see a very low interest rate at that period for about 5 years before we start to see a gradual increments starting from 2014 onwards. Because back then, 2008 to 2013, we was using SIBOR package. It was an all-time low at about 0.3 to 0.4% for 3-month SIBOR. And slowly we see increasing over the years from 2014 to 2019. And that is where the interest rate has been kept all-time low. Because US has also kept their interest rate all-time low, which has indirectly has some impact in Singapore interest rate. In today's situation, we have COVID, and again, US has kept their interest rate at all-time low, but their inflation rate is at all-time high now. So indirectly, when US increases their interest rate, we will see that there's some movement in Singapore market interest rate as well over the last couple of years, when every time when US announced that, saying that, oh, we are going to increase their interest rate. So what we will foresee moving forward, what will happen in Singapore market as well as the interest rate, is that we will potentially see a gradual increase of this interest rate. So we don't think, of course this is our personal perspective, we don't think that with this war for Ukraine and Russia, it will not slow down or it will not keep stagnant because of the inflation. It should be on a gradual increment, but there is also a potential that the interest rate high. Instead of an increment of 0.25, maybe the increment might be much more. So this is how it will actually affect our mortgage loan interest rate in Singapore. So if you want to have a peace of mind, you might want to consider to go into a fixed rate option within the next 3 months, 6 months when you're doing your refinancing, so that you keep yourself safe and you are not affected in the event there's an interest rate high. If you are in the process of buying a new house which is completed, we will recommend you to look at the fixed rate option, although there is still a gap in terms of a floating versus a fixed. But by going for a fixed rate, it's like you are getting a protection for yourself. Fixed rate, although it's higher, you're paying like an insurance premium. For the next 2 or 3 years, your interest rate will not hike because of market fluctuation. So you are, in a way, you are safe if you are going for fixed. But if you are going for a floating package, example SORA, you are opening yourself for risk in terms that if interest rate high, your interest rate will actually increase gradually according to market. If you are going, depending if you are going with a 1 month or a 3 month SORA, because a 1 month SORA means that your interest rate tends to change every month. But if you are going for a 3 month SORA, technically your interest rate will change every 3 months. So in a year, if you are going for SORA, it might change 4 times. So that is where if you are on SORA package and the interest rate is on upward trend towards maybe end of the year or starting of next year, when interest rate hike, you are straight away affected. So if you are still unsure in terms of which bank to go for, or a fixed or a floating package, we will be more than happy to talk to you and give you more in-depth information to make a better decision for your next upcoming purchase a home loan or in terms of refinancing. Just feel free to click on the link below. One of my colleagues will actually reach out to you and advise you.